Why are stocks now moving to the downside, pricing in some kind of activity or volatility going into this election?
Well, it was around 3 a.m. this morning Eastern time when the futures, which were already down about 20, took another leg lower because of the weakness in Europe. But I think behind the scenes here is the market's reaction to earnings generally, and particularly technology stocks. You had Microsoft, which reported a great quarter, but sort of modest expectations relative to what the estimates are. So that stock is down. I think the canary in the coal mine for tech was on October 15th when Fastly reported, and that stock was down sharply because it had a very rich multiple going into earnings. Earnings were good, but because of TikTok not exceeding expectations by a sharp amount, and that stock sold off. You saw Chegg, you saw Netflix, you saw SAP, Twilio, all high-flying, expensive stocks that didn't meet expectations. So maybe, just maybe, with respect to technology, which has obviously been leading this market, valuations now matter. And if valuations now matter, the bar is high as we get earnings, particularly tomorrow and over the next couple of weeks.
Well, that's so interesting to hear because what many people have been focusing on as of late, the last couple of weeks, 2 to 3 weeks, has been the notion that it's the election uncertainty that's causing volatility. It's some of the concerns about COVID-19 that are causing the volatility here. But you're saying that it's the company-specific stories and the market overall that could be due for this pullback, and that's the reason why you're seeing it?
Well, it's probably a combination, but I can't discount this reaction in technology. Again, we have very rich valuations. We have particularly software stocks trading at 20, 30, 40 times sales. These are extraordinary levels. And Fastly in particular, just to bring that name up again, going into their earnings report, stock was trading at about 45 times sales. So there's no room for error here. And I think that is, with technology being obviously such a dominant driver of the market gains this year, that if technology slips up, it's going to be really tough for another group to offset that.
About a month and a half ago, 2 months ago, maybe a little bit longer, we were talking about this idea of a possible great rotation happening, that we could see technology start to underperform, that we could see value-type sectors like industrials, materials, beaten-up names in energy start to lead the way higher. It sure doesn't seem like that's playing out. What do you think is going to happen in the next couple of weeks here?
Well, it played out up until this week where we did see some rotation, particularly commodity stocks traded well with the CRB index ticking higher. When we had the steepening of the yield curve, banks actually showed some signs of life. But it's going to be in fits and starts, particularly as we have to go through the winter with the virus until we know who's going to be president by next Tuesday. But I do think that the stage is set to have tech underperformance, at least maybe through the rest of this cycle, and that maybe tech relative to the rest of the market has topped out.
Shepard Smith here. Thanks for watching CNBC on YouTube.